Hello and welcome to the Wealth Management Invest podcast. I'm your host, David Bodamer, with the wealthmanagement.com editorial team. I'm very excited on this episode. I'm happy to bring on the show Stephanie Drescher, who is the Chief Client and Product Development Officer with Apollo. Stephanie, thank you so much for coming on the podcast.
Thank you, David. Happy to be here.
So just to, kind of before we get to some of the questions I have for you, if you just want to give folks a quick sum up of what your role is and what your place is specifically in terms of like what financial advisors may be interested about what you're doing.
Absolutely. So my role when I first joined Apollo 20 years ago was to build out the client and product function focused primarily on institutions, the sovereign wealth funds, the pension plans, etc. In the last few years in particular, look to complement that mature business by providing access to advisors in the wealth community at large, so RIAs, wires, private banks, and deliver the same institutional quality capability and investing, but in formats that were appropriate and made for advisors to serve their clients. So my day-to-day focus is very much on building out that capability to deliver to our partners, to the advisors, and ensuring that their clients can meet their long-term goals as they build wealth and plan for retirement.
So I believe Apollo's target for assets in the global wealth channel is 150 billion by 2029. Is that right?
That's correct.
So that's a very, it's a big number. Apollo's, it's used to big numbers. So I know you guys do, you've got this, a massive, all these lines of business, but why has Apollo identified private wealth as a growth area and why you're so optimistic about getting to that kind of a number within the next few years?
The reality is that in comparison to the institutional investor, the level of assets is actually very similar, call it 150 trillion or so in assets in each of those respective markets. Yet when you look at the allocation to private market exposure for your average institution or even your ultra high net worth family office, it easily clears 20%, sometimes 25% plus on average in that institutional world. Yet in comparison, the individual has approximately 3% in private markets. And the impact, certainly I've seen it throughout my career, and plans kind of demonstrate this. The benefits of adding that private market exposure to what would otherwise be a predominantly public market 60-40 mix is very meaningful in terms of delivering excess return per unit of risk, creating diversification, and ultimately reducing volatility. So it's our conviction in providing access to these private credit, private equity, real asset exposures is evidenced in what we've seen the institutions benefit from over decades now. So recognizing that the exposures today are a small fraction of what the institutional market has built, we believe that the opportunity for us to make sure that we provide the appropriate offerings, education, etc., for the advisor community and ultimately their client, the individual, is a massive opportunity. And therefore, the 5-year plan highlights the growth that you mentioned earlier.
So I think one of the barriers historically has been things like the minimum investments to access private markets has been, like, up until the past few years, was fairly high. And also there were capital calls. There are all sorts of things about accessing private markets that served as a barrier to the wealth channel. So how, and I think that's something that's being addressed now. So can you talk about how even how some of the innovation is making the access possible?
Yeah, that's a great point. We're in a very different place in terms of innovating and meeting the advisors and the clients where they are. And what I mean by that is, as you suggested, when I first took a white sheet of paper to the wealth business 3, 4 years ago, I wanted to start with a listening tour of
Hmm.
what were the challenges that advisors were facing. How could we make it more efficient, more accessible, and really add to the educational tools that were out there? And a number of the challenges that I heard related to J curve,
Hmm.
funding, capital calls, as opposed to the ability to access a seasoned portfolio. So
Hmm.
we solve for that. I also heard some advisors share what what I call kind of the allergy to K1s
Hmm.
and tax reporting. So we deliver 1099s whenever we can, which is very common now. Minimums was another, so we were able to take those down as advisors and their clients built out diversified portfolios and exposures. We also were focused on regulatory regimes, and we recognize that clients globally are working with different requirements, and we wanted to make sure that we provided access points for different regulatory backdrops. Currencies became a preference depending on where an advisor or client sits, and so on and so forth. So our mantra is to provide a range of solutions, ultimately in strategies that run deep in terms of underlying markets, match our capabilities as a firm that date back now decades, 3 decades, and and then with those kind of scaled, pooled capital solutions, we can overlay what we call the access points that tailor for the needs of the individual. So now we have over 11 strategies in the semi-liquid space,
Hmm.
and that is matched with about 30 different access points, recognizing the needs of our global investors.
Can you just like draw out what the difference between those the access points and the 11 and the 30? Just like what does that mean exactly?
Yeah, absolutely. So the strategies, the 11, focus on credit, so private credit, equity, and real
Hmm.
assets.
Okay.
And so within credit, for example, we'll have an option for corporate origination, asset backed origination, or multi sector. That's what I mean by
Got
strategies.
it. Okay.
But then within each of those strategies, we will have an access point for those in non US markets, those that
Hmm.
might want the Hong Kong dollar, those that want to wrap that underlying exposure in a vehicle that's applicable for the defined contribution space, right? So those are access points. That's what I reference as the 30 that uh, recognize the underlying needs of the clients or where they may want to place the strategy. But the actual kind of strategies themselves, we have about 11 or so across our suite of asset classes.
Got it. That's helpful. And I mean, it sounds like just actually kind of overwhelming. I'm used to I've talked to a few other asset managers, but mostly talk about the US market, but you're global. So you're actually not just, so it's complex enough, just I think like when you're talking about some of the structures in the US, but then global, I know that like, the limited liquidity vehicles in the US, we've got like interval funds and tender offer funds, but then in Europe you have LTIPs. So that seems kind of I mean, to me, it seems very overwhelming to think about. Not only have to think about like currencies and the different regulatory regimes and the different structures that you're using in order to be a truly global enterprise. So that's really fascinating to think about that.
You know what? It's been the most fun yet.
Hmm.
I think about what we've been able to create in the last 3 years, we've increased from kind of fewer than 10 dedicated resources to global wealth to now approximately 150 on a global basis. And to your point, like the commitment starts at the top and it's real. Because of that, I think only a handful will do this really well on behalf of partners globally. But when designed at scale with the strength of commitment that we have as an organization, we have so much fun showing up for our partners and clients every day and innovating to make sure they get the best of our capabilities.
Yeah, that was actually going to be my next question too, because I know that Apollo has spent a pretty significant amount of time and effort to build this internal wealth team that's got 150 people, and I think you have aspirations to grow it even more. So that's in itself, aside from just the servicing the building the products, but also building the team is a pretty big endeavor. So I was wondering about like what that's been like in terms of just identifying talent. What has the approach been? What are some of the, and what are like the capabilities that you're building into the in-house team, and why did you feel like you needed to do that in-house? I know it's a lot of stuff.
Yeah, no, absolutely. The way I thought about it was, how do we show up as the best partner to the intermediaries, to the advisors, to the private banks, wires, RIAs, family office, and what does it take to be the best as we have those conversations? And part of it, to your point, was the solutions themselves. So making sure that we had the range of solutions that would help them meet their respective goals, whether that is building wealth, saving for retirement, etc., or even multi-generational sometimes. One part was building the product suite, which we certainly have and will continue to refine. The second piece was around the relationships that will make sure that we cover those different channels and geographies by delivering one Apollo. And what we mean by that is we want to deliver the best of the firm as we show up to partner with our clients. So we have products, we have those that cover the relationships with that one Apollo mindset. And then I also wanted to make sure that we had the educational tools to help guide our clients and prospects, because as I mentioned earlier, there is a big delta between the allocations institutions have made over decades now versus where we are, broadly speaking, with individuals, and making sure that we provided modules on the underlying asset classes within private markets and why it makes sense to add the private market exposure to a 60/40 portfolio, or how we share our thought leadership from a macro perspective, and on and on. Building Apollo Academy was the third piece of the plan, which has taken off, and we can speak more about that. I also want to make sure that we invested in tech, not just for our own sake as a manager, but to help the industry just make the process of accessing private markets that much easier, more efficient and scalable. So through a portfolio of investments and partnerships that we have forged, we've allocated now about $1 billion of our balance sheet in wealth tech, fintech opportunities consistent with that mission. And then finally, I'd say making sure that once we have these global partnerships and approvals, of which we have more than 500 global distribution partnerships and relationships at this point, that we showed up as best in class in client service and experience. So each of these are super important as we built out our wealth function and continue to reinforce those aspects of the business so that we can keep on kind of delivering for our clients and getting better and better at what we do. So that's the underpinning for the increase that you mentioned from roughly 30 billion of AUM today to our 5-year plan target of 150 billion.
And one of the, I think you're alluding to, you were just talking about partnerships. Recently, you just announced there was a with Apollo, with sorry, with iCapital, the Apollo allocation pro.
Correct.
Can you talk about that? And I think Apollo's relationship with iCapital goes back much further, but this, in terms of this new development that you've added.
Yeah, so the Allocation Pro is part of our Apollo Academy, and we did partner with iCapital to help the advisor see on a more interactive basis how the portfolio private market allocation can impact and ultimately address the needs of their underlying portfolio. It's been a terrific initial step as we give more tools, more resources to advisors as they think about the inclusion of private markets in the portfolio.
So, kind of a more global question. Given your experience, that you came up and you were working with institutions and then you switched over to wealth, are there have there been big surprises about that, or big differences that you've noticed in trying to bring product to the wealth side that's different from institutional?
But I guess stepping back for a moment, what has certainly resonated with advisors is this idea that when they look at the public markets, historically they saw public as safe
Hmm.
because it was more liquid, and private markets as risky because it was a relatively small allocation to highly illiquid opportunities. The definition of alternatives is changing rapidly.
Hmm.
And there's a fundamental rethink in terms of how to perceive risky versus safe. And the reality is that both the public markets and private markets are safe and risky. And it's a matter of manager selection and portfolio construction that ultimately allows you to address the long term needs of the client. The fundamental difference between the public and private world is liquidity.
Right.
And that is has already changed very meaningfully, where the semi-liquid offerings in particular are allowing a very attractive entry point that kind of sits between the daily liquid options and what has historically been seen as the classic drawdown 10-year plus in the private markets. So, and in certain parts of the private market, like let's say corporate IG, the ability to provide liquidity is emerging quickly and certainly offers far more liquidity than what someone would have perceived in kind of a more traditional kind of private equity venture type of drawdown. I think if we look at the high level in terms of the education and the wealth market, there is great appreciation that the classic 60/40 public portfolio is not going to deliver on their long-term expectations. But the introduction of private market exposure as a replacement for a portion of public fixed income or a portion of public equity
Hmm.
can in fact deliver that excess return, albeit with a bit more illiquidity. And the backdrop, frankly, of the public equity markets, for example, having such increased concentration
Right.
due to the Fab Seven, due to kind of the massive decrease in the number of public companies, I think has really set the stage for how this exposure can be a really important tool in portfolios going forward.
Yeah, I think there's a lot of figures that people point to around, but like you've talked about the reduction of the number of public companies, and then the fact that some private companies are staying private for longer, the number of jobs that are actually the amount of growth that's actually embedded in the private markets. So by you're just missing out on all that if you're only looking at public equities. And that's just on the equity side, not even talking about the debt, the private credit side.
Right. No, you're absolutely right. And people don't often focus on the fact that 90% of all companies are in fact private. And yet to your point, like we used to have 8,000 public companies. We now have half of that.
Right.
So I do think it's a meaningful difference in just kind of the foundational view of public versus private. And we're seeing that in conversations with advisors. And then as it relates to the solutions for their portfolio, what's great is that they have tools, they have options now where they can either take a specific strategy and like our corporate origination and have that as additive exposure to what otherwise would have been their public fixed income, let's say. But they can think about it as a combination of what we have in our solution set and think about it as a bundle, or they can overlay it with tax efficient structures, or as we mentioned earlier, potentially even a defined contribution wrapper. So the innovation to your earlier question, going back there, has been super exciting to be a part of because we we're focused on ensuring that we are aligned with the goals of the advisor and their client. And there are so many more tools now at the advisor's disposal to ensure that this type of diversification is built into a range of portfolios. It could be
Right.
brokerage, it could be discretionary, it could be the defined contribution. And then to make sure that it's just structured in a way that makes it super efficient for them.
Yeah, I think an exciting or interesting development too with just when you have the proliferation of more options, when you talk about the possibility of allocating to private markets, you don't you can actually pick a blend and not just be like, all right, I'm going to pick one private market fund, but maybe I want a little bit, if I want to really get a good diverse allocation of private markets, I should probably have some real assets, some equity, some fixed income, and maybe a little bit of more of each. And then if you can add diversification not just to private but within private, that can feels like that's could be very powerful for like um creating a more robust client portfolio.
Absolutely. And providing that excess return kind of per unit of risk. And ultimately, from a portfolio perspective, you're right. Once you can speak about a mix of solutions across asset classes, which we certainly do every day with our clients, then the discussion is about how will that mix of exposure help them with increasing diversification, lowering vol, and providing that excess return. So there's been a real shift in thinking about kind of that classic definition of alternatives, the kind of the kind of your grandfather's private equity or venture
Mhm.
exposure to where we are today, where an alternative can simply be an alternative to a public stock or bond, and making sure that it delivers the excess return for the unit of risk.
And there was one other, I think, really important point you made earlier, which was about manager selection, because I think I know one of the things I've heard like on the advisor side is, around some hesitance around private markets was some bad experiences from maybe a decade ago or whatever, there's some prominent things that happen at that point. But I feel like one of the most fundamentally important parts about what's happening now is the quality of the managers who are offering solutions to the markets are people like Apollo, and not, you know, somebody that's maybe, you know, like, for lack of a word, like a snake oil salesman. Like, you actually have best in class operators creating products for private wealth, which I feel like is like, again, you know, like a big part of what's changing, you know, why this is actually really taking root so much right now.
Yeah. Look, that institutional quality access is critical. And our our mantra here is we we are looking we deliver the same sourcing, same underwriting,
Hmm.
kind of same rigorous investment process and risk management, whether the underlying client is an institution, a private bank, a family office. The process from an investment perspective is the same. The access points are then designed and tailored to the needs of the respective channel. But I think it's super important that
Hmm.
all of our clients, irrespective of type, know that we are aligned with them in terms of our capital and our process in delivering kind of the highest quality outcome. And on the alignment itself, so I think that's critical and is a commitment that is held throughout the firm. The alignment point is another one where we are typically the largest investor in each strategy that we manage on behalf of our retirement services business at Athene.
Hmm.
And so when we think about our balance sheet, we we are consistently the largest investor in the pool of capital in which our clients are investing in and the underlying assets that they have exposure to. And we often say it doesn't guarantee the outcome, but it certainly guarantees a shared outcome. And that alignment is very important to us and then ultimately to the investors that entrust us with their capital. So I think it's a combination of distinguishing ourselves based on the commitment we've made philosophically at the top that does permeate the entirety of the organization, the the capital that's required and the continued investment in making sure that we can show up as the best partner, and then actually the capital aligned to the underlying strategies that we're offering our clients for, in fact, that shared outcome. All of that resonates and I think is super important as we speak to our investors globally.
Well, Stephanie, I've taken a good chunk of your time. I kind of lost track of time because I was so fascinated by your answers and just thinking of more things that I could ask you. But probably should let you go. But you know, but before we wrap up, I just wanted to give you a chance for, you know, any like takeaways or final thoughts that you wanted to offer to our audience.
Look, I've thoroughly enjoyed the conversation, David. I would say that, you know, when I think about the Apollo of today and the Apollo I joined kind of 20 years ago, there's there's so much that is consistent with, frankly, what drew me originally, you know, that and the energy, the entrepreneurial spirit, the commitment to innovation, a collaborative culture, and I do believe that those principles, those values, really help for us to build and deliver what we have in the wealth space as well. So much more that we can talk about, but hopefully we'll do that on a follow-up episode.
Sounds good. And is there a good, you know, is there a place you want to point people to on the Apollo website for, you know, more
Oh, sure.
information?
Great thought. So publicly available, we have apolloacademy.com. and feel free to visit. There's a lot of great insight and material, and we welcome your participation and any follow-up questions that anyone has that can be submitted through apolloacademy.com.
Great. Thank you so much, Stephanie.
And thank you, David, for facilitating this conversation. It was interesting. Increasingly, I hear talk about alternative investments and private markets. So thank you for exploring that topic today. For people who are listening to the podcast, David, who might have questions for you or just want to reach out to you, what is the best way for them to do that?
You can find me on LinkedIn. It's the best way to kind of ping, follow, ping. We post all our episodes there. Also, just in terms of our day-to-day investment content, please come to wealthmanagement.com and go to the investment section. We try to, write as much as we can about the developments, both in traditional strategies, ETFs, SMAs, but also in what's this whole burgeoning private market space for wealth advisors.
Great. Thank you. And for those of you who are listening to this podcast who are not subscribers, this is very easy. Reach out and hit the follow button. Subscribe. That's because when you do that, you are automatically notified of any new episode that David drops. You can give it a listen. The other thing I would ask is if you like the podcast, you find it interesting, share it with people. Word of mouth promotion is a very welcome tool, and we would thank you for that. So we can just sign it off with until next time. Thank you for listening.